What's making headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie and Ben here today, unpacking some of the big news we've been writing about this week and looking forward to the week ahead. How's your week been, Ben?
Yeah, it's been a good week so far. A few interesting stories as well, and as always, lots going on.
Lots going on. Our colleague Will Page, who you might know from this podcast, is actually away on leave at the moment. I think he's in New Zealand. Lucky for him. So we'll be manning the fort here today and unpacking the news that we've been writing about in Will's absence over the last week or so. Starting with a big one that kind of broke on Monday. Well, we broke it on Monday. Talking about Westpac over in New Zealand. Now, this is a really interesting story. I was hearing a lot about what was happening over the Tasman with the major bank, and this is specifically Westpac NZ, doesn't really talk about Westpac Australia. But what I was hearing was that they'd been in conversation with aggregation groups over there in the last few days, talking about scrapping trail commissions for mortgage advisors over there. So brokers in New Zealand are called mortgage advisors. And this is really interesting. So they've been going on and we confirmed there had been conversations had over the last few days talking about this pretty imminent proposal to remove trail commission altogether. Now, a lot of people obviously talking about what is this going to look like? What does this mean? And just to give anyone who's not familiar with the New Zealand market, generally, most banks in New Zealand actually don't pay trail. Most of them got rid of it a few years back and they pay a higher upfront commission. Some of them, however, including Westpac, still do. They pay about 0.6 upfront and then about 0.2 trail. Now, I haven't been able to confirm those specific numbers. That's what I'm saying about. But yeah, they were apparently having conversations with aggregators about getting rid of the trail and instead moving to a higher upfront. What do you reckon about that move? Do you think mortgage advisors in New Zealand would be happy about getting rid of trail?
I don't know. It's hard to say. I guess the one thing that really interested me, this story, and I guess it probably speaks to my ignorance of the New Zealand market, was how many loans in New Zealand are actually fixed rate rather than variable. And I think David McQueen from Loan Market pointed out, but like 90% of loans are actually fixed rate, which is very different to what it says here.
Completely different. And so therefore, I think that's probably what Westpac is thinking as well. It's like, well, if a broker is introducing a client, let's say it's a 4 or 5 year fixed, why are we paying a trail on that? Because they're not actually supposedly doing any post-settlement work, really. They haven't said that. And actually, they said, it's too early to comment, basically. When I reached out to Westpac NZ to be like, tell us what you're doing. They were like, we're still in conversations. I'll actually read what the spokesperson told me. They said, we're in discussions with our advisor network about some commercial aspects of our relationship. We are currently considering a range of feedback and no final decisions have been made. We can't comment further while the conversations are ongoing. Now, they've said that, but the people I've spoken to for this story, I spoke to about 4 different people, were kind of saying, that's not how we've heard it. They were saying they pretty much took the conversation from Westpac NZ as being, this is happening, we're letting you know, rather than being, we're floating this idea, what do you think? So interesting to see those two takeaways. And I think, as you said there, Ben, a lot of them kind of saying, well, if so many loans are fixed, why are we paying this sort of ongoing annuity when we could just be paying a higher upfront? Now, I think some mortgage advisors in New Zealand might be like, great, I get cash in my pocket immediately, I get more of that cash. But then the question that David McQueen, who I was speaking to for this story, because they have one of the aggregators in Australia that have a presence over in New Zealand, he was saying, well, actually, it might drive the wrong behaviours if you're only rewarding a mortgage advisor for introducing a client. Surely that would encourage churn. Now, he's saying that's not probably going to happen because a lot of brokers are obviously wanting to work in the best interest of their clients and they are ensuring their client is happy. But if they're only being paid for an upfront, the risk is that you're really providing them with a remuneration incentive to keep moving people around, which might not be great for them. Of course, if you're finding them a a bargain each time, happy days. But I thought that was really interesting. And we also spoke to Peter White for this story. He's the managing director of the Finance Brokers Association of Australia, but also the Finance and Mortgage Advisors Association of New Zealand. He's sort of both. And he was saying, we can't interfere in Westpac's commercial arrangements, but the industry must be given fair notice of any change. Westpac needs to be very clear as to what's happening, as there's too much speculation in the marketplace at the moment. Advisors are rightly concerned about their future, as many have trail incomes built over 10 years of supporting Westpac. And he also called for past trail commissions to be protected. And I think that is key, because so many people value their business, build their business based on the value of their trail book. So if suddenly they don't have that trail, what happens to the value of their business? So I think that's going to be a really interesting time over in New Zealand to see how mortgage advisors shift. I did talk to a couple of mortgage advisors over in NZ. Unfortunately, none of them were willing to go on record about it. But the sort of gist of what the conversations I was having were around the fact that they were saying, you know what, because so many lenders already don't pay trail, I've kind of already moved away from that model. I'm not kind of accounting for the value of my business in that way anymore. So for them, they were kind of like, meh.
Yeah. Do they think it's something we could see here eventually, or it's just
I
a
think
different
that
market?
is the risk. And of course, that's why I was talking to the aggregators here that have a presence in both Australia and New Zealand, as being like, would this happen over in Australia? Would Westpac Australia do the same thing if Westpac New Zealand have done it? Now, I did reach out to Westpac Australia and they were like, we're not going to comment on this. This is a matter for Westpac NZ. But they did emphasise that Westpac obviously is really values its broker channel and it has been investing a lot in the broker channel. Of course, they're not going to say anything on record, but I kind of feel like it would be weird if they did it.
Yes, yeah. And I guess, as we sort of mentioned before, two very different markets. And
completely different markets. Also, broker channel here much larger than it is over in New Zealand. But yeah, I can't imagine seeing Westpac Australia getting rid of trail commission in Australia for brokers. And if they did, there'd be a lot of fuss. But yeah, I mean, we keep hearing, probably every year we hear a new rumour of a lender changing commission structures quite substantially, and they don't tend to eventuate. So we'll have to wait and see. But for now, I'm not confident that Westpac Australia would do it. And I kind of feel like if they did, they'd be really hurting themselves, if anything, because so many brokers would probably revolt about it.
Absolutely, 100%.
Speaking of the major banks, though, that wasn't the only one making headlines this week. We also heard from ANZ earlier in the week, one of the latest lenders to change their cash rate forecast. Ben, you were across this for us. What were they saying?
Yeah, so ANZ has revised its cash rate forecast. ANZ now sees the first realistic chance of the next rate cut occurring in February, because it believes that's kind of like the period where the RBA should have a clear sense of whether or not inflation is under control. So I think 3 of the 4 majors have now
moved. Yeah,
I think
Westpac might be the only one.
Yeah, I think
Westpac,
NAB and CBA have pushed their expectations of the next cut.
Westpac is hedging, aren't they?
Westpac is hedging.
So Lucy Ellis, who's the chief economist over at Westpac, she was saying it's not certain that we'll have a rate cut in November, which is the next rate decision. But she was like, but we're basically holding our forecast as a rate cut in November, which all the other 3 had. But as I say, NAB was the first one to move a couple of weeks ago, and I think we talked about that in this podcast. And they said it was after the monthly CPI data came out. They were saying because of this being a bit higher than we thought. Higher? Lower?
High inflation.
High inflation would mean cutting. Different than they thought. Then they were saying, we think it will be February. We don't think they'll be needing to move anytime soon. I think it was lower than they thought, and then employment was higher. So NAB moved, and then CBA moved maybe 2 weeks ago or maybe the beginning of last week. So they moved as well just after the RBA made its rate decision for October. September, October. So they changed theirs, and then now ANZ saying also February. So
depending on who you think is going to be right, it might be a little while before you'll get some rate relief. But it is always a bit of a movable feast, and the economists are sort of making these predictions based on data that's coming in. So, I think it's probably prudent that if they're getting data that's telling them something else, that they change
the forecast. 100%. You don't want it to be based on data from earlier in the year.
Yeah,
so
exactly.
But yeah, so I think ANZ moved theirs because they had seen the statement from the RBA following its cash rate decision in September, October, on the 30th of September, and they were saying it was a bit more hawkish than they were expecting.
Yeah.
And I think CBA had said that as well. And then they were actually also having done their inflation preview for the quarter, September quarter? Yeah, must be. And said actually they think that will be increased as well. So they don't really expect a cut from the RBA in November. So a few more months to wait, because November, then I think there's another one in December, rate decision. So a couple of months before potentially we see any more reductions in cash rate.
Yeah, we'll see what happens. But it should be interesting to sort of see where it all lands.
Yeah, and the other question I think as well is not only when will they cut, but also how much more will they cut. So I think most of the banks now say the terminal cash rate for this easing cycle will be 3.35%.
Yeah.
I think maybe one other is saying it will be lower than that, 3.1, which was the forecasts at the beginning of the year. And off the top of my head, I can't remember who that is.
ANZ did say the likelihood of multiple cuts has diminished. So I guess.
Yeah. But I think ANZ's now saying they remain one more cut more likely than not. So I think, that is the question, as being like one or two, but probably not going much lower than 3.35, maybe 3.1, which that would probably be neutral.
Yeah, just about.
That would be, good news if they did. No Christmas presents though for us, or holiday presents for us ahead of the break, which is rapidly coming up. Can't believe we're already in October. The clocks have changed now. It feels like summer is here, so we'll be quickly ramping up to the end of the year. So I really expect to see a lot of flurry of activity in the next few weeks. I'll take a quick break here, and when we come back, we'll be talking about the flurry of activity over at the aggregators, as they've been announcing some changes, and we'll get into that just after this. So, Ben, you were writing this story for us. Australian Finance Group, AFG, coming out with an announcement that was pretty interesting. What have they done?
So this week we found out AFG had taken another equity investment in a broking business. It's taken a 40% equity investment in Brisbane-based asset finance brokerage Network Finance. This makes Network Finance the fourth brokerage AFG has invested in. As part of the broker investments program that we sort of found out about at the end of last year. So AFG now has equity stakes in Melbourne's Empower Wealth, Perth's Lifespan Mortgage Services, and Sydney's Loan Path Finance. Network Finance is the first asset finance aggregator. Asset finance brokerage, for AFG to take a stake in. And it's kind of as part of their strategy to sort of use cash reserves to invest in these high growth brokerages.
And I love that AFG is listed, because anytime they do anything, they have to announce it to market pretty much, or at least something that's substantial. So we do see quite a bit from AFG. Unlike some other lenders and aggregators that are not listed, we have to kind of go and chase them for information. But really interesting to see these acquisitions as part of the broker investments program. And as you said, the first asset finance brokerage they've taken a stake in. AFG, of course, has its own asset finance aggregation arm for intelligence. So they are already, pretty interested in asset finance broking already. But AFG, as you said, have already so far invested in 3 other companies. And these are like chunky investments. I think the ones, I don't know if we heard about what the actual dollar amount was for this one. I think the last one they didn't tell us, but we know the first couple were like millions. So I'll be interested to see the financial reports when they came out, so we can have a look at the detail and actually find out what the numbers are. But asset finance brokerage investments. And I think this is really great for brokers who have built really big businesses. So, I mean, all 4 of these are quite, big broking businesses. They're doing really well. And obviously that's probably why FG wants a stake in it. But it's really interesting to see this dynamic where an aggregator is saying, we think your business is so good, we actually want to not only help you grow it, but kind of take a little bit of meat from the pie.
Yeah, and it'd be interesting to see what that process looks like, how AFG is sort of coming into the business, what are the sort of advising these businesses and getting them to do. I think, as we sort of said in the story, Network Finance has been with AFG for quite a while. I think since 2015, I think.
And it's because the last one they did, it wasn't an AFG brokerage, which was pretty interesting. They kind of took a stake in it. And obviously, as part of that deal, that brokerage moved to AFG. It was previously with another aggregator. So it's interesting to see not only are they looking within their own house to see who they can acquire in, but they're also looking further afield.
Yeah, I guess whatever opportunities make sense. And we're going to see a lot more of this over the next few years. I think AFG has said its ambition is to invest in 35 high caliber groups by 2029. So,
yeah, and I think the principal, the managing director of Network Finance, Craig Titmus, he was saying actually this really helps us give us equity to capital and expertise we need to unlock future growth. Of course, like having a big investment like that, and saying we've got enormous potential in residential and commercial lending too. Yep. So interesting to see them looking at diversifying the brokerage as well. That wasn't the only aggregator, though, we had from this week. Connective also changed some things. What have they been doing?
Yeah, so Connective announced this week that it's rebranded its white label portfolio. So it has, we've reported on this quite a bit, but Connective sort of has 8 white label products now, which previously fell under the brand name Connective Home Loans. Yep. But they're all types of different loans, I think. There's sort of loans for self-employed, there's bridging loans, there's all sorts of subsets. So these products will now fall under the new name Connective Lending, starting immediately, I think.
Yeah, so and this is interesting because I think Connective Home Loans, I guess, really pins them into just having mortgages.
Yeah.
If they're Connective Lending, they can do other stuff. They could do asset finance or commercial, or, like sort of working cap type loans. So I think maybe that's part of it, is we'll potentially see new product ranges coming in. So it doesn't make sense to be called Connective Home Loans anymore. But the other part of it is because they're also looking increasingly at funding their own loans, which they hadn't previously. I think Connective Home Loans Suite originally started with white label products funded by other lenders. So we've got the big kind of white label funders in there, Think Tank and Pepper and Bridget being the bridging loans one. And I think recently they launched their first one, which they'd funded themselves, or at least they have some sort of agreement with the lender, which gives them the ability to sort of provide their own credit risk appetite.
Yeah, so this we reported on this at the start of the month. They launched Connective Complete, and I think that's sort of backed by Red Z initially.
Yeah.
But it's kind of positioned as the first flagship product, flagship white label product for Connective.
Yeah, it's almost like they've become a mortgage manager. I think from how we understood it is that they were using Red Z to kind of actually, I'm assuming, fund the loan, but also to then process the loan. But they had their own, again, like assuming credit risk appetite for this specific product, which they probably don't for the others. Like I think most of them would be still falling under the credit risk appetites of the funders. So I think this was the first one they were like, it really is our own loan and we can control it, even though somebody else has given us the funds.
Yeah. And a lot of people are using these products. I think we reported on this earlier, but in the 6 months to 30th June 2025, Connective reported $2.6 billion in settlements from these products, which is up 18% year on year. So plenty of brokers are sort of
lots of brokers using it. And I'm always really curious about white label lending, because from, a broker perspective, it might be great to have access to something that's probably a little bit quicker. You can probably access it more quickly. I assume there's probably higher commissions, or at least more favorable commissions on them as well. Now, I haven't looked at the Connective one's remuneration structures, so I'm assuming that. But I'm always a bit like, would someone actually want to take out a loan with a brand they don't know? Because for the wholesale independent aggregators, Connective, AFG, Finshaw, for example, most broker clients wouldn't have heard of them before. So if you're suddenly getting a loan that's Connective Loans, I'm a bit like, who are these people? Like, I don't know if that works in your favor.
I guess if the rate's appealing enough.
Yeah, if they've got a good enough service proposition. And I guess from a broker's perspective as well, it kind of makes them kind of say, oh, I've got this special access to this special product you can't get anywhere else. So they might quite like it as a positioning of, sort of unique offering. But yeah, I always think white label's really interesting. And as we've talked about a lot on The Advisor, a really big area that the aggregators are looking at as they're sort of deciding how they can make a little bit more net interest margin and kind of make a little bit more money. A lot of them have been pushing their white label suites, looking at their white label products. And, AFG's got AFG Securities and AFG Home Loans. So both funded themselves, but also funded by other people. Connective has their own Connective Lending. And I think, who else has got them? There's a few. Loan Market has its own white label. Mortgage Choice has its own white label.
Aussie, Finsure, YBR, they've all sort of launched white label products.
They've all got them. YBR as well, actually.
Yeah,
securitized their own after a long time. So, yeah, really interesting to see lots more of the aggregation groups pushing into these spaces and trying to kind of do lending as well as broking. And I wonder how long it is before people start looking at these numbers, particularly if they get really high. Like if 50% of an aggregator's loans are written by themselves, I wonder if the regulators would have issues with that around conflict.
Yeah, could be interesting, but definitely watch this space.
Watch this space. And of course, like if you've got any thoughts on what white label loans are like and whether you've used one, what you think of them, let us know. We'd love to hear. You can reach us at editor@theadvisor.com.au or just reach out on the Advisor website, and all our emails are on there too. We'll take a quick break here. When we come back, we'll talk about the flash that went out this morning. Naughty neobanks from back in the day. If you remember the neobanks, APRA taking some action against some of the former leaders of the neobanks, and we'll get into that just after this. So this morning, the potential regulator announced that it was actually making disqualifications for the first time under the Financial Accountability Regime, or FAR, as we're going to call it from now on, and disqualifying 2 former bank leaders. Now, if you've been following The Advisor for a long time, or Mortgage Business, our sister title, which is now Broker Daily, you'll probably remember all of the coverage we did back in probably starting in 2017, I think it was, 2017, 2018, when restricted ADI licenses were first launched, which allowed people to trial becoming a bank. And then they could move to a full ADI license, so a full banking license. Now, we had a smattering of players who came in under the RADI scheme, including Xinja Bank, which is what we're talking about today. Now, Xinja Bank collapsed back around 2020. So they went through a period where they were trying to raise money. They'd opened deposits. So they were having people, new customers come and join and open savings accounts. And the intention was that they would eventually move to lending as well. And we talked to them a lot when they were doing all of this, and because they had intended on working with the broker channel. But of course, then COVID hit, and that caused obviously a lot of issues for a lot of people. Funding markets completely dried up. There was some real, problems across the board, across the globe with funding. And this really put the neobanks into strife. A lot of them really struggled to get any kind of funding to really set up and do enough lending. And of course, while most banks will fund their mortgages and lending products from their deposits, when you're new, you don't have that much money to give out. So they were still working, trying to do capital raises, but eventually collapsed in 2020. In 2021, they handed back their banking license, and I think their clients went over to NAB. But what's interesting about this is that APRA was saying, so APRA back in 2021 changed the rules for what it takes to be a restricted ADI and have a banking license because of the Xinja collapse. And they were saying, we really want to make sure that banks have enough capital, they don't collapse, and that if they are kind of, setting up, that there's really a lot of support in place. But they'd done an investigation into, obviously, the collapse of Xinja, as you'd expect they would do, because they were like, how did this happen? And COVID's one thing, obviously, but generally something else might have been going on. And what they found was pretty interesting. So this is coming down into like the real brass taxes of capital raising. So excuse me if I butcher this, but basically what they were saying was that they had been told that Xinja had entered into agreements with investors to raise CET1 capital, which is generally the highest quality capital you can have. And Xinja apparently told APRA, yes, this is all CET1 capital. However, they conducted an investigation and found that the transactions actually involved Xinja entering into side agreements together with share subscription agreements with investors. So they're saying this wasn't true CET1 because the actual additional terms undermined that status. So they were like, not only did you misrepresent what you were doing, but you told porcupines to us. So they were angry on 2 different fronts. Firstly, obviously, that it wasn't as strong or unquestionably strong as they wanted it to be. And secondly, that when they were looking at this information, when they were being asked about this information, they were showing them documentation that, according to APRA, had been fiddled with. So naughty And because of this naughtiness, they have now disqualified 2 of the former leaders. So the former CEO, Eric Wilson, has been disqualified for a period of 8 years. And a former non-executive director, Craig Swanger, I'm not sure how you pronounce that, sorry. He's been disqualified for 10 years. And that's because he was supposedly the one who was doing allegedly some misrepresentations on the paperwork. So APRA came out this morning and said, these are the first 2 people we've disqualified under the new FAR regime, which came into effect in 2024, last year. And yeah, saying they basically failed their accountability obligations by not acting with enough due diligence, without having to kind of worked with APRA in an open way. And then obviously, as we sort of said, supposedly removing crucial content from specific investment arrangements when showing that to APRA. So the Deputy Chair, Margaret Cole, came out this morning and she was saying an accurate understanding of banks' capital adequacy. I'm going to say that again. So Deputy Chair of APRA, Margaret Cole, came out this morning and said, an accurate understanding of banks' capital adequacy framework is essential for APRA to protect depositors by ensuring banks have the financial resilience to withstand a crisis. It is vital that accountable entities and accountable persons are open and cooperative with APRA so that it may effectively discharge its responsibilities for overseeing the safety and soundness of Australia's financial system. That all sounds fair enough to me.
Yeah, I think so. And often with cases like this, it all comes out in the wash. So
it all comes out in the wash. But no, this is really interesting because I think Xinja Bank, it was maybe one of the first, I don't think it was the first, but it was one of the first of the neobanks to have shuttered. We know a range of others. So for example, if you remember Volt Bank, that opened up as a savings account. I actually had a Volt Bank account when it first opened and wanted to have a little play and have a look at what it was doing on the neobanks. I opened up accounts of pretty much all of them. But yeah, they collapsed. So I think that was in 2021. And again, having issues with raising funds. And that was really sad because everyone was super excited about what they've been building. The technology looked amazing. They had some really great, interesting things with open banking going on as well. So Volt Bank closed, Xinja Bank closed, 86400 then got bought by NAB and became Ubank. Who else do we have in the neobank scene? A range of them. A couple of the foreign ones as well that I think have since closed. So yeah, a lot of neobanks that had started under the Ruddy regime no longer around. And I wonder if APRA's having a look at how else the others were managed and what else led to their failures. That was a big one this morning. But looking forward, I mean, it's already the first week of October. As we've said, the clocks have changed and the October magazine is just about to come out. So on Monday, I think it starts hitting desks. And this is always really fun when the mag comes out. We get to see everyone's reactions to it. People who are included in the magazine are like, it's so cool to get it through the post box if they're a premium subscriber, or to see it online if they're not. And this month's cover story, the Elite Broker Ranking Residential, spoiler alert, being announced next week. That's the cover story on the mag. So if you submitted into the ranking to see if you were the top most prolific residential broker in Australia, then do make sure you check out the October edition. Because Ben, you've got a lot of features in this edition too.
Yeah, well, we've the Elite Broker Resi, it's one of our really big issues, but we've also got a feature on reverse mortgages sponsored by Household Capital, and one on the deposit hurdle sponsored by Deposit Power.
Yeah.
Deposit Powder. But yeah, super interesting too. Both working on both of those features to talk to people from the businesses, and as well some brokers who are kind of writing those loans as well. And it comes at an interesting time, I suppose, with the home guarantee scheme being
expanded. And I think that's why we were really looking at the deposit hurdle as being like, aside from the home guarantee scheme, which I'm sure everyone is sick of hearing about now. Yeah. It's kind of like, aside from that, what else are people doing? What other tools are available? Because not everyone will want to buy a house that's under those property price caps under the home guarantee scheme, which, for Sydney, for example, is 1.5, I think. So if you want to buy property that's in higher value than that, but you don't have a 20% deposit or a 10% deposit, what can you do? So really interesting to hear from Deposit Power for that feature about what they can offer brokers and how brokers have been using their products, what sort of scenarios they're available for. And reverse mortgages as well. Really big issue at the moment. Lots of people retiring and thinking, What do I want to do with my life? What do I want to do with this property? Can I pull some equity out? Can I maybe take my grandkids on holiday or, do some renos before I sell this house? So reverse mortgages, again, seeing a really big trend, and Household Capital talking to you for that. What do brokers sort of think about reverse mortgages?
They were actually sort of saying it can, in the right sort of circumstances, it can make a real life-changing impact on a borrower's life. I guess, as you sort of said before, of those examples, it could be a borrower who wants to take their family on a holiday, but it could also be someone who desperately needs to sort of do renovations on their kitchen or something like that.
I've got a leak.
They desperately need a leak or something like that, or they could have medical expenses and that kind of thing. So, and if their property's gone up in value however much, and there are safeguards in place too, I guess, which is something we get into in the feature as well.
Yeah, so, I think whenever we talk about, products specifically targeting older borrowers, there's always that question of, making sure you're being responsible when you're talking to an older borrower, that there's no financial abuse going on there, and that actually they're clear and conscious and compos mentis. They know what they're signing up for. So lots of safeguards in place to ensure that people taking out these products are aware of what they are, of what the repayments look like, of what happens to their asset. And also, of course, because of property for a lot of people is their kind of legacy for maybe the rest of their family, making sure they know that there's a caveat sort of on here. So yeah, really interesting feature. Thanks, Ryan, for that one. And we did mention already the Elite Broker Ranking Resi coming out. And then November, it will be the Elite Broker Ranking Commercial, which includes commercial mortgages and working cap. And then December is Elite Broker Ranking Asset Finance. And then February, top 25 brokerages. So we've got these major magazines coming out in the next few months, really providing a sort of overview of the top players in Australia. So really excited to see those. And of course, in the October edition as well, we've got a summary of the Australian Broking Award winners as well, which we held in August. So if you didn't make it along to the awards and you want to have a little peruse about who won what, that's in the magazine as well. If you're not already a premium subscriber, you can jump on the website, theadviser.com.au, and become one to make sure that you get sent a copy of the mag in the post. You also get a whole host of other benefits, including a free ticket to Better Business, discounts on our events and awards. You get photos from the awards, you get seals, you get research, you get extra reports, you get a whole ton of amazing content and discounts. So do make sure you check it out if you're interested. Ben, any nice plans for the weekend?
I think I'm going to take it easy this weekend. Yeah, I guess we don't have that extra day this time around in New South Wales. So probably just going to lie low. Yeah,
lie low. I'm actually heading off on holiday for the next few weeks. I fly off today. I was like, what day is this? I fly off today and go to Singapore and then over to Europe, go back and see my family for a bit, and then pop back at the end of October. So if you guys have any stories, scoops, thoughts, concerns that you want to have aired in The Advisor, then Ben and Will Page will be your people on the ground here on The Advisor while I'm away. But yeah, I'm excited to have a little break, and hopefully it won't be too rainy over in Europe. I'm also going to Italy for a little bit.
Yeah, it'll be a nice break, I think.
Yeah, come back refreshed and fat, I think. For anyone else, we hope you have a fab weekend, and we'll catch you next time for another episode on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.